Okay, welcome to Compliance School, where today we are going to talk about KYC and AML. So, Chris, take it away first.
Know your customer, or KYC, is a process which describes the need for businesses and institutions like banks, for example, to collect and verify information about customers. So if you're running a business, for example, then you yourself actually will have to comply with certain KYC requirements. The purpose of KYC typically is to prevent money laundering and terrorist financing. The basic idea being that in order to really do business with anyone or to allow anyone onto your platform, you need to actually know who that person is, at least some level of identification. KYC requirements vary from industry to industry and country to country. When you're applying for a loan or opening a bank account, the KYC requirements will be very diligent. So not only do you need to enter your personal data, like your name and your address, but you might even have to upload a proof of residence, a proof of income, some sort of employment contract. If you're running your own business, then you need to be very aware of KYC requirements of your industry.
And the other side of this is AML, which is what we call anti-money laundering. And in the last episode, we talked about how money laundering is the process of introducing illegally obtained money, whether through drugs or other criminal activity, and you're trying to bring it into the legit economy in exchange for goods, services, or clean cash. Anti-money laundering typically provides a large framework designed to prevent businesses from being misused by money launderers. And there's two key concepts in here. One is due diligence, and two is risk assessment. So number one, due diligence describes the process of knowing and understanding your customer before, during, and after a transaction. Risk assessment, the second part, means your ability as a business owner to actually identify or assess the likelihood that a customer will misuse your platform to finance terrorism or launder money. And so one example could be like if you run a poker site, how do you know someone is not just losing on purpose to money launder? That's kind of just a quick example. And so as a result, large businesses usually have these compliance departments to assess the risk on a continuous basis, whether or not they should keep doing business with certain people. And as a result, some businesses in the US have actually stopped servicing or even displaying their website to Europeans, for example, because you have GDPR regulations, which is something we'll also talk about in the future. But I think as a business owner, whether you're doing a token offering or you're a fintech company, this is something that you need to pay attention to.
And one really important concept that Terry just touched on is risk assessment. And in order to do that internally for your business, you'll most likely want to set up a risk framework. And the risk framework essentially details a number of scenarios that are likely to happen in your business. These could be how you handle customers or what kind of customers you're dealing with, or they could even be about your employees. How likely is it that your employee or your customer will misuse your platform in order to launder money? A risk framework allows you to assess the risk of these different scenarios happening, and therefore gives you a much clearer picture over how big of a risk money laundering and terrorist financing are to you, which is absolutely key because you do not want to be misused.
So this framework will help you with the three factors that we talked about here, with risk assessment, non-detection, and probability. It'll kind of get you started in a very quick way too. So thanks for tuning in, and we'll see you next week.